Fed's balance sheet just a whisker under $7 trillion. The ECB, their balance sheet, right, a little bit over $6 trillion if you put it into dollars, about 5.5 trillion euros. And if you look at a chart of both on top of any equity index, what you'll find is when balance sheets go up, stocks go up, balance sheets go down, stocks go down. Your thoughts, Jim?
The rate of growth in these things, Rick, is nothing less than astounding. If you take the past 3 months of the Federal Reserve's balance sheet and annualize it, the rate of growth is 606%. Money supply year over year, the broadest definition of money supply, is up in excess of 20%. So these are figures that, like so many figures and facts nowadays, one had not previously seen or imagined. So what does it mean? So the future, as usual, is keeping its counsel. But we can observe the following. We can observe that there are almost $12 trillion worth of bonds priced to yield less than nothing. And we can observe that commodities, as measured by the GSCI, are at their lowest relative value compared to stocks since at least 1970. And we can observe that equities are priced, according to Jim Bianco, at the highest forward multiple since at least 2001. So the world, which ought not to dogmatize about these things, is dogmatic that there will not be inflation.
Well, you just hit on the key. I'll give you a what if, a very easy what if. Let's say 3 years from today, we see unemployment at 7 to 8%, and we see inflation at 6%. Is the Fed raising rates or not raising rates?
Fed is not raising rates, not this Fed.
Well, then okay, and that was the answer Ira Harris gave me. So if the Fed doesn't raise rates under those conditions, first of all, do you want to own dollars?
Well, do you want to own those almost 12 trillion of bonds? I mean, bonds are selling as if, as my father used to say, the Russians were in the Bronx. The rate of growth in corporate issuance is almost as astounding as the rate of expansion of the national debt. It took us 192 years to amass the first trillion of U.S. national debt, and we are now adding $1 trillion about every month. Now, this is not an argument about whether that spending is necessary in this crisis, but that's not the investor's question. The investor's question is, what might be the consequences of these unprecedented and heretofore unimagined policies? And we can't know, but what we can observe is that everyone seems to be thinking the same thought. And I'm not sure if that thought is the correct word or not. That is to say, no inflation ever. But you are not being paid necessarily to agree with it.
No, you just hit on the key. Now, in the scenario I outlined where inflation goes up and unemployment is nowhere near where it is on the worst case scenario that we're analyzing with recent numbers, but much higher than it was at 3.5%, 4%. To me, the equity markets may indeed be the vehicle that takes into account that inflation, given some of its price structure. I don't know, given a choice, maybe you'd rather own stocks under that scenario than any of the fixed income products. What do you think, Jim?
Maybe, or commodities, or something besides promises to pay you in the future in the currencies that the central banks are creating in such immense profusion. So this is a world that is preoccupied with financial assets that can't get enough of the debt kind. And I don't mean to insist on a certain outcome, but what I don't understand is this urgency, this almost obsession to get long these things, which almost pay you nothing, and which pay you nothing in a currency that the central bankers are doing their best to depreciate. It is a bit of a mystery.
I couldn't agree more. I couldn't agree more because so many seem to scratch their heads why stocks are doing what they're doing.